Welcome back to Business Pakistan. It is now time for our weekly look at Pakistan's leading capital market, the Karachi Stock Exchange. For that, we'll go to Sabeen Mushtaq. Over to you, Sabeen.
Thanks, Raja. The Karachi Stock Exchange 100 rose marginally by 2.0% to close at the 9,902 level amidst low average volumes of 90.5 million shares during the week. The currency weakened by another 2.0%, touching a record low of rupees 75.0 to the US dollar. July 08 CPI also spiked to 24.33%. Earnings season continues with several major corporates due to announce results next week. Swift resolution to the impeachment process could also have a positive impact on the equity markets. The benchmark index gained 2.0% to conclude the outgoing week at 9,902. An attempt to reclaim the psychological level of 10,000 was turned down, owed primarily to continued political noise, worsening law and order conditions, and the weakening rupee. Investor participation was lacking, which was clearly evident through depressed volumes. The average weekly turnover continued to slide and declined by 17.0% to 90.5 million shares. Furthermore, NCCPL figure debit a withdrawal of US $12.7 million was over the past week. Oil marketing companies announced phenomenal results due to large inventory gains owing to high product international crude oil prices. While the PSO result was in line with expectation, PSO posted profit after taxation of rupees 14.05 billion rupees with an earning per share of 81.94 rupees. The company announced 125% cash dividend. Shell announced a positive earnings surprise. Shell announced profit after taxation of rupees 5.63 billion, EPS rupees 93.76, cash dividend 400% and bonus stock 25% for financial year 08. Earnings season will pick at the Karachi Stock Exchange with several major listed corporates due to announce their results in the coming week. These include OGDC, ABL, MCB, Lucky, ICI, Indus and Pakistan Suzuki Motors. Coming to political situation, I would like to mention that Sindh Assembly adopted a resolution on Wednesday calling upon President Musharraf to either take a vote of confidence from his electoral college or resign immediately. A swift resolution of the impeachment process should bode well for equity markets, while continued delay could have the opposite effect. The designation of President Musharraf could also lead to better performance of Pakistani bourses. However, it's a big question mark how Pakistani bourses would perform next week. Back to Shuja.
Food and transport rate hike has pushed consumer price index to 30-year high in the first month of the current financial year. Romail Kenneth files this report.
There are no signs of tapering off of inflation as the consumer price index surged by a whopping 24.33% in first month of current financial year compared to corresponding period last year. The high growth of CPI, a key indicator of inflation, was caused by a rapid increase in the prices of food items triggered by increase in domestic oil prices. The food inflation also ballooned to 33.81% in July 2008-2009 compared to same month of previous year. According to Federal Bureau of Statistics, on month-on-month basis, CPI was also up by 3.34% over June 2008, mainly on the back of rising transportation charges and food prices. Analysts believe that inflationary pressures are expected to persist in August as the full impact of last revision in domestic oil prices on July 21, 2008 would be seen in August. Given the fact that further oil price increases are in the pipeline, in line with the government's target of scrapping all subsidies, analysts forecast continuation of rising inflation during the current financial year. They said that the trend is expected to continue and the inflation rate for this year could be in the range of 19 to 20%. Apart from the impact of domestic oil price increase, the supply side constraints are also fueling inflation because the new coalition government could not deliver much on this front as hoarding and smuggling of essential food items is still going on unabated. The government spending is also contributing to this trend, which is financed by unsustainable borrowing from the state bank. The central bank has advised the government to retire 21 billion rupees debt every quarter this fiscal year. Analysts added that the focus has not been shifted to economic side as the ruling coalition is still entangled in political issues, which are turning bad to worse with each passing day. The latest move to go for impeachment of President Pervez Musharraf has made matters worse. In CPI basket, the highest growth was seen in Transportation and Communication Index, which rose by 37.18% during the first month of current fiscal year over the same period of previous year. The second highest growth was seen in Food and Beverages, which has over 40% weightage in CPI basket. It registered 33% growth for the month under review. The other categories in the CPI basket were also on the higher side during the said month. Inflation in the first month of current fiscal year were on a much higher side compared to the same month of last year, when it was 6.4% in July 2007. The last fiscal year ended with the overall inflation closing at 12%, missing the target of 6.5% by a huge margin. Government has fixed 8% inflation target for the current financial year, which is termed unrealistic by analysts. During July 2008-2009, wholesale price index and sensitive price index also rose by 34.02 and 32.98% respectively.
Pakistan has received 627 million US dollars remittances in the month of July 2008. The inflow is the highest ever in any single month in the history of the country. Details in this report.
Foreign remittances in the sum $6 to $7 million poured into the country during July. That was the highest single month inflows in the history of the country. Given that the rupee had depreciated by more than 7% during the month against the greenback, the confidence of the overseas workers in the country seems to be astounding, but is that misplaced? Among the host of economists who habitually pronounce gloom and doom for the economy, it is difficult to find a few who look at the sunny side of the picture. Most are the focus on the dwindling foreign exchange reserves, mounting trade and fiscal deficit, depreciation of the rupee and the soaring inflation. According to an economist, the reason that the foreign remittances have soared as those sitting outside the country are looking at the country in the global context. Inflation is a worldwide phenomenon, and so is the weakness of the currency and the stock market meltdown. Pakistan's macroeconomy numbers look dull due to the passes through of high oil prices in the past 4 months. A staggering 71% impact of the high oil prices has been passed on the consumers, says the economist. He is confident that from January 2009, the inflationary figure would dip down to single digit as the economy would have already borne the full brunt of the oil passes through the base of commodity and food prices would rise to international level. Another economist points out that Pakistan micro imbalances were driven by higher oil prices, but with the recent meltdown in crude and commodity prices, the down of 2009 should see trade deficit narrow as exports improve with currency adjustment and imports, which would be costlier, would stand restrained. Already evidenced in the 42% drop in the July auto sales numbers. Reduction in import of oil, wheat and metal would cut down import bill. The government fiscal deficit would be regained in as oil prices pass through might be over. That would result in decreased borrowing from the central bank, while inflows of foreign exchange from privatization, remittances, euro bonds and higher tax collection numbers would have a soothing effect on the economy.
Pakistan's central bank has issued guidelines on internal capital adequacy assessment process to improve the risk profiles of banks and development finance institutions. Details in this report.
The banks and DFIs are required to have a process for assessing their overall capital adequacy on continuing basis in relation to their risk profile and a strategy for maintaining their capital levels. The State Bank of Pakistan said that in order to facilitate banks and DFIs to develop such a process, guidelines on internal capital adequacy assessment has been developed. All banks and DFIs are required to put in place an effective process for assessing their overall capital adequacy in the light of enclosed guidelines. They may adopt any available capital assessment methodology based on their size, nature, and complexity of the operation. The assessment process so adopted should be comprehensively documented and made part of bank and DFI strategic decision-making process, said a State Bank of Pakistan circular. All banks and DFIs were advised to submit the major findings of ICAP latest by April 30, 2009 to the Banking Surveillance Department. It is emphasized that ICAP is an ongoing activity and submission of findings at a particular date should not be construed as a periodical exercise, said the circular.
And that was another story that made the headlines over the week.
The central bank's strict exchange policy measures have failed to stop the fall of rupee against dollar. Analysts said the major reason for this failure is the political uncertainty in the country. As a result, the rupee has witnessed depreciation by some 10% in the last 6 weeks. The rupee is continuously depreciating against the dollar since the last 8 months, and the central bank's measures seem to have failed in arresting the slide, especially in the interbank market. In May 2008, the State Bank of Pakistan imposed 35% LC margin on all imports, except of oil and food imports, aimed to narrow down the increasing trade deficit and to stabilize the rupee. On July 8th, SBP took some other measures to strengthen the rupee, and the central bank suspended the afternoon trading session, banks' treasuries for all types of foreign exchange transactions. In line with these measures, the SBP also announced that it will now make 100% oil payments, besides suspending forward cover facility against imports and advance payments against import with a cut to 25% with immediate effect to rationalize the foreign exchange market. However, all these steps provided a temporary relief to the rupee, and after a short time the rupee is once again depreciating against the dollar, and the dollar has touched a new peak of Rs 76 in domestic currency market. Analysts said that continued political upheaval in the country is hurting the economy badly, and the State Bank of Pakistan's measures to keep the rupee at a sustainable level have also been ineffective. While on account of the continued political uncertainty, a shortfall in the foreign exchange receipts and the exemption of several items from LC cash margin requirements have also put pressure on the exchange rate. Overall, the country's foreign reserves have plunged by some $1.125 billion during the last 5 weeks. The reserves were at $11.284 billion on June 28, 2008. They were $10.1591 billion on August 2, 2008. During the same period, reserves held by SBP have declined by $1.65 billion to $6.968 billion from $8.625 billion. The analyst said that the rupee is under pressure due to the increasing current account deficit and slow foreign flows, besides political events in the country. Official statistics revealed that the country faced a record $14.016 billion current account deficit during the last fiscal year 2008, as compared to $6.87 billion in 2007. Net foreign investment declined by 38% during the last fiscal year due to massive outflows of portfolio investment because of political uncertainty and negative reports about the country's economy.
And with that, this week's Business Pakistan draws to a close. We will be back next week with more news and insight into one of Asia's most exciting emerging markets. This is Shuja Qureshi saying goodbye.